Plug Power is currently trading at $4.05, which is a gain of 3.85% for the day. Now, the immediate expectation for many watching this ticker is that this is just another flicker of volatility in a stock known for its wild swings, another speculative ripple driven by day traders. The reality, however, is that today's upward movement has a texture to it that is different from the random spikes we've seen in the past. We're observing a steadiness in the buying pressure and a trading volume that suggests more than just retail speculation. It points to a subtle but significant shift in perception, where some market participants are beginning to look past the well-documented financial anxieties and are starting to price in operational progress that has been largely ignored by the mainstream narrative. This isn't just noise, it's a signal that the foundational story might be changing right under our noses. For the better part of a year, the common belief surrounding Plug Power has been defined by a few key concerns: its significant cash burn, the alarming going concern warning issued by its own management, and its near total dependence on securing a massive loan guarantee from the Department of Energy. These are valid and serious points that have justifiably anchored the stock in the low single digits. Many investors, whether they are using sophisticated tools like those found with Interactive Brokers or simply making trades on the Robinhood app, have viewed this stock as a binary bet on that government loan. But this perspective, while prudent, is also incomplete. It misses the granular, on-the-ground developments that form the other side of the equation. The market has been so focused on the financial statements that it has largely discounted the company's aggressive and perhaps unprecedented push for vertical integration within the green hydrogen space. The narrative is about financial survival, but the underlying work is about market domination. The challenge for any serious investor is to reconcile these two opposing forces. It's a classic dilemma in online investing. Do you focus on the red ink of today or the potential green fields of tomorrow? Let's break down the recent stock movement with more detail. Today's 3.85% climb didn't happen on a single news-driven spike. Instead, the stock found a floor early in the session and has been methodically building on it. The trading volume, while not astronomical, is showing a higher proportion of buy-side orders, suggesting accumulation rather than frantic short covering. This is a pattern that professional traders using advanced platforms like the Interactive Brokers trading platform look for. It's a sign of conviction. When you compare this to the action in the broader clean energy sector, you'll notice that while some solar and wind stocks are also up, Plug's performance is slightly outpacing its peers. This indicates company-specific factors are at play. Furthermore, we're seeing this strength in the face of persistent macroeconomic headwinds. Higher interest rates typically punish cash-burning growth companies like Plug Power, as it makes their future earnings less valuable and their debt more expensive. The fact that the stock can rally in this environment hints that investors are perhaps weighing the long-term thematic importance of energy independence and decarbonization more heavily than near-term interest rate policy. It's a dynamic many are tracking across their portfolios, whether they hold Tesla stock, Apple stock, or are diversified through Fidelity mutual funds. The resilience is noteworthy. For anyone with an individual brokerage account, watching this kind of price action separate from the broader market is a key indicator. To understand the stakes, we have to be crystal clear about what Plug Power actually does. This isn't just a fuel cell company anymore. Plug is aggressively building what it calls a turnkey green hydrogen ecosystem. This means they are involved in every major step of the value chain. They are building electrolyzers to produce the hydrogen from water and renewable energy. They are constructing liquefaction plants to turn the hydrogen gas into a dense transportable liquid. They have a logistics network for delivering it, and finally, they manufacture the fuel cells that use that hydrogen to generate power. Their primary market to date has been in material handling, powering forklift fleets for major companies like Amazon and Walmart. But the grander vision extends to stationary power for data centers and utility grids, and eventually powering heavy-duty transportation like trucks and ships. This vertical integration is their biggest gamble. If it works, they could control a significant portion of the entire green hydrogen economy in North America, creating a powerful moat. If it fails, the capital expenditure will have been immense. It's a high-stakes strategy that many investors using services like SoFi Invest or Schwab Intelligent Portfolios are watching closely, as it represents a pure-play bet on a future energy source. The company's past performance has been the source of the market's deep skepticism. A history of missed production targets and profitability goals has created a credibility gap. The going concern warning in late 2023 was a stark admission that without new funding, its ability to operate was in question. This is the reality that has kept institutional capital, like that managed by Fidelity Wealth Management, largely on the sidelines or in underweight positions. The expectation was set. This is a company on the brink. However, recent developments have begun to chip away at that dire outlook. The company has secured some smaller financing deals and has been vocal about its cost-cutting measures. More importantly, its new production plants are starting to come online. The facility in Georgia is now producing liquid green hydrogen, and the plant in Tennessee is expected to follow. Each kilogram of hydrogen they produce internally, rather than buying from the volatile open market, improves their margins and reduces their operational risk. This is the tangible progress that the market is slowly beginning to price in. The journey from construction to full profitable utilization is long, but the first steps are being taken. Looking toward the future, the outlook for Plug Power hinges on a few critical factors, creating several possible scenarios. The most significant catalyst, without doubt, remains the $1.6 billion loan guarantee from the Department of Energy. Approval would be a massive de-risking event. It would not only provide a huge injection of low-cost capital, but would also serve as a powerful stamp of validation from the U.S. government, likely opening the doors to more private financing. Denial or a significant delay, on the other hand, would force the company to seek alternative funding, which would almost certainly mean a highly dilutive equity offering, putting severe pressure on the stock price. The Department of Energy's decision on Plug's loan guarantee is a massive factor here. Comment below with approved or denied and tell me what you think the outcome will be by year-end. Beyond that single event, operational execution is key. The market needs to see a clear and consistent ramp-up in production from their new facilities. They need to demonstrate that they can produce green hydrogen at a cost that is competitive with traditional carbon-intensive hydrogen. This is the ultimate test of their business model. Risks are plentiful. Competition is heating up, with industrial gas giants and energy supermajors also entering the hydrogen space. Execution risk is high. Scaling complex industrial processes is notoriously difficult. And the financial tightrope they are walking remains precarious. However, the opportunity is equally immense. If global decarbonization goals are to be met, green hydrogen is not an option. It is a necessity for hard-to-abate sectors like steel manufacturing, aviation, and shipping. Plug Power, despite its flaws, has positioned itself as one of the most advanced pure-play vehicles for this transformation. This is the kind of high-risk, high-reward profile that attracts active traders on platforms from SoFi to Robinhood. In summary, the story of Plug Power today is a perfect illustration of the tension between market expectation and underlying reality. The prevailing expectation is that of a company perpetually on the edge, a speculative bet entirely dependent on a government lifeline. Today's stock increase is seen by many through that same lens, as fleeting and unsubstantial. But the deeper reality is that while the financial risks are deniable and severe, the company is making tangible, albeit slow, progress in building a vertically integrated hydrogen business. The market is beginning to recognize that operational milestones, like the commencement of production at their Georgia plant, are meaningful de-risking events in their own right. The ultimate trajectory of the stock will not be determined by one day's trading activity or the latest analyst note. It will be forged by the company's ability to execute its ambitious plan, to transition from a company that consumes cash to one that generates it. The chasm between its current state and its stated goals is vast, but it is in that chasm that the greatest risk and the greatest opportunity reside. Plug power, ... Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Please don't forget to like, comment, and share this video to support the channel. Thank you.